Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So we got to talk about an article that came out from Better Dwelling. It's titled Canadian Consumer Insolvencies Only Surpassed by 2010 and 2020 Peaks. So the article goes on to say the Canadian economy may be outperforming, I don't know about that, maybe you might say the growth data, but households are getting slaughtered, right? Now, if you remember, previously I talked about the unemployment rate that continues to move up higher. So I don't know if the economy is really outperforming. You may look at other parts of the data and may argue that, but I don't see it as that, especially when you have job losses increasing and when you have a lot of companies that are holding back in terms of hiring. Although the Toronto Stock Exchange continues to make all-time highs and continues to move up higher, sitting at 26,306. But yet, people are feeling more pain in the economy as prices continue to be elevated, as people continue to lose jobs, and as these insolvencies continue to increase. And we're seeing it here in the data. So the latest data from the Office of the Superintendent of Bankruptcy, OSB, shows consumer insolvencies surged in March. The 12-month volume has reached levels only seen during the 2010 and 2020 peaks. These both periods were known for sharp declines in economic activity, while annual growth had been slowing. March's sudden spike suggests this trend may be worsening before improving. So, Canadian consumer insolvencies continue climbing from pandemic lows. OSB reported insolvencies jumped 11.2% to 12,126 filings in March, just 4.9% higher than last year. Monthly data usually isn't noteworthy due to seasonality, but noteworthy since it was the biggest jump since mid-2020. Now, when you look at this article and this chart, I'll link it in the description so you can check it out. If you look at it, Jan 2020, from March 2020, from March 2013 to Jan 2020, we saw quite the increase in insolvencies, and then all of a sudden we saw a massive drop afterwards, right? Same thing in December 2009, we saw from December 2007 to December 2009, we saw quite the sharp increase, then followed by a drop, right? And what happened again in those times is those recessions, those economic contractions, and the real estate market, if you remember in the US, that really bottomed after around 2011, 2012, right? And then as things start to get better, you start to see these insolvencies rise. And now what we see here, the COVID lows of in this data, we're seeing March 2021 being the low, rise rapidly all the way to March 2025 of this year, back to Jan 2020 levels, and rising at a very, very steep pace. And what's very interesting is that every time this happens, or tends to happen, we tend to see something in the economy eventually break, which I'm going to get into quite shortly here. So over the past 12 months, Canadians filed 137,000 plus insolvencies, nearing the pandemic era peak. The volume is 8% higher than last year's, up from February 7.4%, which has previously marked the slowest growth in 3 years, while the broader trend had been decelerating. March's abrupt reversal erased some progress. It was only a single month, and 1 month isn't a trend, but it can signal the start of one. Consumer insolvencies typically peak before the recession. Okay, history shows Only two periods were comparable insolvency levels: the global financial crisis, early 2010 peak, and the pandemic, March 2020 peak. Insolvencies peaked early in these recessions, suggesting today's numbers might foreshadow an economic downturn. Recent data shows signs of peaking, with 12-month growth starting to slow. This aligns with historical numbers and starting the narrative that a recession is underway or imminent. Whether March's acceleration was noise or the start of a second wave of debt reckoning fueled by trade war remains unclear. So here's the thing, right? We're seeing, not only in Canadian data, but in US data around the world, seeing it not with consumers, but institutions, governments, the debt level and the insolvencies levels continue to rise. And we're getting rate cuts. Rate cuts are supposed to save the day in Canada, supposed to save the real estate market, and so forth. Not exactly, right? It's still crickets in the real estate market, even though we've got multiple rate cuts, and we're going to get more. Trust me, we're going to get more, especially if something breaks, right? Now, when you look at the stock market, especially the Toronto Stock Exchange and the U.S. markets as well, we're seeing it pull up and make new highs, and especially the TSX sitting at all-time highs. That's not, don't confuse that with what's happening today in the economy. Just because the stock market's going up doesn't necessarily mean that there isn't problems in the economy. The stock market often gets it wrong. And there's a lot of emotions and manipulation and fear and greed that can move the markets higher or lower, right? And especially after all the fear we saw with Trump's and his trade war, we see this massive squeeze higher where people were quite bearish or on the sidelines, and we're seeing basically all those shorts basically get out of their trade, right? So that's more of a technical thing. So if the stock market's going up, it doesn't mean anything. And this is not a suggestion whether to short, to sell, to buy, or anything like that. What you do in terms of your investing is totally different than what the data is coming out in terms of the real economy. But what we can't ignore is the real economy and the signs that you are getting higher unemployment rates. You are getting those job losses. You are getting insolvencies. You are getting cracks in the economy, which are showing up deeper and deeper. Thus, you are getting the reaction from Bank of Canada to cut rates, to come and save the day, to eventually print money, right? So those moments are yet to come, and they're slowly coming together, but it's just going to take its time because the economy is not like the stock market. Okay, it doesn't react so quickly. It's like moving a massive ship. It takes time for it to turn, and the same thing will go with the economy. So the signs are there, the cracks are there. We're seeing signs of it, and these peak levels will eventually decline, and eventually we will see the recession, and usually we will know when it's already too late, right? What you can expect when you look at real-time data, you can expect by looking at let's say the real estate sector in terms of supply and demand. You can look at it in terms of rent. You can look at it in terms of what the central banks are doing, the printing of money, right? The bond market, etc., etc. So there are some data that you can look at as months progress. Now, in terms of the trade war, where this ends up, playing out, we'll see. But with this Trump pause with China and other countries, it doesn't necessarily mean it's still a good thing for Canadians, because there is still that trade war still happening with US and Canada, and there hasn't been much progress yet. And on top of that, right, with all this disruption, we can expect inflation or prices to be elevated. And with that disruption that has happened thus far, the beginning of this year, right, we've seen the unemployment rate spike up to the 7% level, and we haven't even hit the peak yet, the peak pain level yet, and this is just the beginning. So anyways, interesting article here. Check it out. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified of the next video. I'll see you guys around. Cheers. Bye.